So now we're live, so they'll see us whenever they come on.
Okay.
Is there a way we know? You must be able to see who's
Yeah, I can see
where on
who's.
this.
Oh, here's somebody. They'll start pinging on all at once.
Hey, Robin, is there a chat room that we would see someone post?
Yeah, there's a Q&A section and a chat section. They're
Would-
on the, you should see them on the bottom, the icons.
You pull down to the bottom of the screen and then that black bar shows up.
Yeah,
Yeah.
Yeah, I'm
so
not
they're all
seeing
coming on
that.
now. So maybe give it another 2 minutes and then start.
Okay. You tell us when.
Okay.
Boy, I'm not seeing that, but so Kathy, you'll have to pay attention to that because I'm not seeing where those would show up on my.
Okay. Yeah, I can make it show up just by kind of pulling my cursor almost down to the bottom of the screen, and then that black bar shows up. Are you seeing it, Rick?
Yeah, I see it too. Once
right.
we get to your guys' sections, I'm happy to read off questions or
Okay.
interject if that'd be helpful, Ben or Kathy.
Yep. Between the two of us, we'll see them.
Okie dokie.
Okay, so it's a little bit afternoon time, so I think we'll go ahead and get started. Thanks for joining everyone who's attending today. And I'm Kathy Green. I'm with Clifton Larson Allen CLA here in Phoenix. And I also have with me Ben Darwin, who is also in the Phoenix office. And then we've got Rick Kruger, who was kind enough to join us from Milwaukee. And the three of us together are going to be talking about the tax implications and the rapidly changing environment with all of the CARES Act and the COVID-19. And one of the reasons that we asked Rick to join us is because he's part of the national group for CLA that's been really involved with all of the PPP loans and the EIDLs and all of that. So he is really up to speed on all of those changing dynamics that we're seeing the last couple of weeks. And so probably the next slide, Ben. So today what we're going to talk about is, as I said, Rick's going to talk about the whole PPP EIDL situation. And then Ben and I are going to talk to you. Ben's going to talk to you about the business aspects of the CARES Act. And I'll talk to you about the individual aspects. And then, Ben at the end will talk some about the possible savings, for cash with different tax strategies. And there's a chat section that's here. So, we welcome your questions. We may not address them, right at the moment, but we're going to be keeping an eye on those, and we'd like to be beneficial for you. So we would welcome the questions. Okay. All right, Ben, I think next one.
There we go. Well,
all right.
Yep.
Rick, take
All right.
it away.
Well, thanks, Kathy, and thanks, Ben, and thanks to everybody for inviting us here. Like Kathy mentioned, there's a lot going on. There's a lot changing day by day, hour by hour, minute by minute. Sometimes it feels like. So we do have information in the slides. I'm definitely happy to talk through that, but also happy to bounce around a little bit and answer specific questions. So feel free to use the Q&A. Kind of a reasonable sized group here. So happy to make it as interactive as you all would like to. But to start off here and just tee up some of the conversation, there are an absolutely overwhelming number of economic relief programs, especially if you consider some of the state and local programs that are out there. For this, we're going to talk and focus in on the big federal loan programs and start there. So starting with the first one, Paycheck Protection Program, the PPP. This came out of the CARES Act, signed into law late March. The initial funding for it ran out in mid-April, and they just reopened the second round. The law was signed at the end of this last week, and the SBA started taking applications through its E-Tran system about 9:30 Central, so 7:30 Phoenix time yesterday. Off to a clunky start, as we've come to expect with this, but it is accepting applications, and we are hearing people getting funded through this next round. Probably won't last very long, though. We're thinking probably a few more days, and it'll run out of funding again because of the volume of applications that were already sitting with banks. The second program out here, the SBA's EIDL, Emergency Injury Disaster Loan, and then also they added to that with the CARES Act an emergency grant up to $10,000. That too ran out of its initial funding around mid-April. The new law that was signed at the end of last week refunded that, but the SBA is still processing the old applications prior to when it closed in mid-April. So they're working through those, first come, first serve. Haven't reopened it back up. I'm not quite sure whether or not they will, but they say as they make it through the applications they have, if there's funding left, they'll open it back up. But again, we are hearing some organizations, fewer than PPP, but some that are starting to get funded through that again. The third program, which we'll talk just real briefly on, is the Main Street Lending Program. This one, not all the details have come in yet, and we'll talk just a little bit on that. Ben, would you mind flipping to the next slide, please? All right, so up on the screen here are some basic eligibility criteria, but I'm going to mention something that's a little bit more recent and didn't even make it into my slides here just because it is attracting a lot of attention, and a lot of organizations have questions on this. So for PPP, beyond just the basics, as part of the application, there are two very important certifications that management makes. One relates to economic uncertainty and the necessity to take a PPP loan to help out. And the other is the intention to use the funds to retain workers and maintain payroll. This is getting a lot of press. The Treasury and SBA have issued a couple of FAQs on who shouldn't have taken the money. And in their view, I think they're getting more and more aggressive with that. Treasury Secretary Mnuchin had a press conference yesterday morning in which he said, everybody that has a loan over $2 million and some beneath that are going to get an audit by the SBA looking into eligibility. Did you really meet those certification criteria? And there's some information there too on how you can return the funds between now and May 7th and get a kind of a free pass. If you made a bad certification, you can be okay. This has a lot of people nervous. A lot of banks have been sending out information on this, and customers, borrowers aren't really sure what to do. You know, how I would say to respond to it, first and foremost, we don't know a lot about PPP. They're issuing these threats without giving us a lot of guidance. But what we do know is documentation is going to be critically important when it comes to PPP or any of these programs where you're certifying an economic need because of COVID-19. Make sure you're documenting. If you haven't yet, do it now about your thought process at the time of application. And certainly if you have any uncertainty, these will ultimately be legal questions about sufficiency and play out in that sort of a setting. So attorneys are well suited to help out with some of this, but I know it's getting a lot of attention here, so at least wanted to mention that. I also see a little chat here about movement, additional funding that would include 501c6 organizations. I imagine this is for PPP. EIDL is a little bit broader, and I'll caveat to say I'm not positive which types of nonprofits are eligible for EIDL. I believe C6s would be included there. For PPP, I haven't seen that much movement from lawmakers to expand that, especially with the funding going so fast. I think at best we'd hope additional funding might include something like that. There certainly are a lot of lobbying organizations that have been pushing to expand the eligibility, but I haven't seen anything to date that would allow you to do that. Ben, would you mind flipping to the next slide, please?
You bet.
Thanks. All right, so Main Street, I'll just mention a couple of things here, and you can see some of the terms as they currently sit on the screen. There's really two options with Main Street, and with all of these programs, you're actually eligible to take all three of them, EIDL, PPP, and the Main Street lending programs. There's just some restrictions on how they play with each other. For example, PPP and EIDL, you can have both loans, but you can't use the loan proceeds for the exact same purposes or same dollars. So if you're using one for payroll dollars for a certain time period, you couldn't use the other for the same. Main Street, you can take in addition to those two, but there's two Main Street programs and you can only do one or the other. One is a new loan program, and that's that MSNLF, and the terms are up there, and there's also a refinancing option as well. Not all the rules are set though, but if you are interested, I would say definitely talk to your lender now. There are some calculations around EBITDA that have some complexity to them, take some time to work through. So definitely good to start talking through that now. Make sure you understand who can take your application and what sorts of information they'll be looking for when they can take it. And now jumping into PPP loan allowable uses and forgiveness, since this is such a hot topic for everybody. A lot of organizations have gotten funding or been lucky enough to get funding for PPP. Now the question is, what do we have to do with it? And how much of this is going to be forgiven versus become a 2-year term loan? So before we dive into the calculation, thought it's helpful to point out some of the key terms within the CARES Act and PPP, just to make sure we understand the distinction between the two. One is allowable uses, that this is government money, and as you'd expect with government money, there are strings attached to it. So you have to make sure you're following allowable uses and documenting that you're following allowable uses for the PPP proceeds. There's a time period for that, which runs from February 15th through June 30th, in which the money needs to be spent on these categories that are laid out here. The one item that came out in an interim final rule, this wasn't in the CARES Act itself, but Treasury released this, is that last bullet, which says at least 75% of the loan proceeds needs to be spent on payroll costs. This has been raising a lot of questions about what it means, especially if you took the loan and it was sized based on your 2019 payroll, and maybe 2020 doesn't look exactly the same right now. What happens if we don't meet that 75% threshold is a big question mark, and we all wish we had more guidance. All we really have are some of the threats from Treasury of what happens if they feel you haven't met the requirements there. So it's certainly something to have in mind and pay a lot of attention to. On the other side is forgiveness here on the right side. There's a lot of overlap between allowable uses and forgiveness, but a couple of key differences. One is, you can see on the left side, interest on mortgages, which is the second bullet, and then a little bit lower, interest on any other debt obligations are allowable uses for PPP. They're not necessarily all forgivable uses of PPP proceeds. We're looking for a little bit more guidance on what exactly, what interest can be forgiven out of this. So there's actually been no guidance that's been released yet. They're a little bit late. They were supposed to come out with some over the weekend, according to the law. So eager to find out a little bit more. Another key difference is the time period. Forgiveness is based on the 8 weeks starting at loan origination. All right, on the next slide here, just a couple of reminders on allowable uses and tracking, and if you had to pay attention to a few things right now, what might they be? You know, I'd say doing our best to understand what these loan proceeds can be used for is really important, and paying attention to that 8-week period for forgiveness is really important. It starts when the loan is funded. You want to track information in real time. There's a couple of options here. You know, whether you want to have a separate bank account, if that would help out. If you want to use some of your general ledger capabilities, if you can set up something there to really make sure you're tracking what's coming in and going out as far as allowable uses and forgivable uses of these funds. But the key thing is document and be prepared to support. On the slide after that, we talk a little bit about some of the information that's likely to be required. What the CARES Act does is lay out a little bit of information on what the forgiveness process looks like. And so here's some information of what we know so far, what we expect so far to be required here. There's going to be an application process on the back end of these loans. So after you make it through your 8 weeks, potentially after you make it sometime after 630, you can apply with your lender to have some or all of the loan forgiven. They'll require certain documentation. They'll go through a process, and then they're required to conclude on forgiveness within 60 days. Some of the details are yet to be determined around that, but we do expect they're going to ask for a lot of this type of information. Payroll reports, payroll tax filings, invoices, canceled checks, agreements that relate to mortgages, debt, leases, things like that. We expect them to be asking for. Good to have your ducks in a row now. As far as loan forgiveness and the formula itself, I'll just real briefly talk through this. Again, it'd be really helpful if Treasury had released guidance, and we were hoping to have a little bit more concrete to talk through it at this presentation, but and that includes the SBA, is saying the same thing. They don't know how to deal with some of the detailed questions until Treasury actually puts it on paper and issues it to everybody. But of what we do know, the way we think about forgiveness at CLA is really a kind of a 4-part test. So one, of the loan proceeds that we got, did we spend enough on allowable cost? Did we spend all the money on items that are allowable for both allowable uses and allowable for forgiveness? 2, did we maintain the number of FTEs during that 8-week covered period compared to one of 2 different comparison periods? One of the comparison periods is a period of time from 2019, and one is January and February of 2020. You do have the ability to rehire people, so they don't necessarily expect you to have everybody back on staff day 1 of the loan, but they do, if you want full forgiveness, expect you to have the FTE number back up by 6/30. Third test, did the entity maintain wages for at least 75% of the prior quarter? So for most employees, and this is an employee by employee test, for most employees, this would be Q1 of 2020, you do get to exclude high earners. It's a little bit of a funny rule, but anybody that made over 100,000 in 2019, or anyone who had a single paycheck in 2019 when annualized would be over 100,000, you don't have to apply that test to, which is nice for employers. And the fourth test is of the amount you spent, was enough of it on payroll, because there's a limit on those non-payroll items of 25%. And then last thing I'll mention here is just really pointing out some of the big question marks. And these are items that we're tracking. We meet regularly. CLA has a few lobbyists that we work with. We meet with other firms, law firms, SBA. These are questions that all of us have yet. But since they're probably running in the back of anyone's head who has a PPP loan, at least want to mention it so that you know kind of why we didn't go into more details. But some of the bigger ones are accrual versus cash. So we've got an 8-week period. Does that include 4 paychecks? Does it include 5 paychecks? What about bonuses or retirement payments that maybe occur outside of that time period? We really only know what's in the law itself, and the CARES Act itself says costs need to be both incurred and paid. They use the word "and" during the 8 weeks. We're hoping they ultimately become a little bit more flexible with that, but we really just don't know. We also have been hearing whispers that some people think that 75% payroll threshold is going to be an all or nothing when it comes to forgiveness. That would be scary if that were true. We don't necessarily read it that way in the rules right now, but we're certainly hearing some whispers and plan to keep abreast of that. And some of the others are a little bit more mechanical details of how exactly the calculation works. As written, the wording is a little bit wonky around some of this stuff. And related party rent, that a lot of businesses have leases with related parties. We don't necessarily know if all of that is going to be allowed or not. And the last one is just a Q&A that came in here, and I'll answer real quick if that works for Ben and Kathy.
Mm-hmm.
So when I calculate the amount of payroll expenditures for forgiveness, do I calculate highly compensated at their actual rate or the prorated 100,000 rate? The answer is the prorated amount. The way it reads is that you would take the 8-week equivalent for 100,000, and that's the cap for what's allowable for forgiveness. So that works out to be 15,385 would be the max of cash compensation, but then you can also add non-cash compensation on top of that. So retirement is still included on top of that cap. Group health is still included on top of that cap, things like that.
Great. Thanks, Richard. So, all right, we're going to shift gears and move into the tax incentives that were part of the CARES Act. And I'm going to focus on the business sections of it. So the CARES Act was actually, you know, the word CARES comes from Coronavirus Aid, Relief, and Economic Security Act. I actually didn't know that till I got to start working on this presentation. So, you know, the act was designed to create some immediate benefits in the form of the financial relief that Rick has talked about. It has as well significant potential relief for taxpayers. Kathy's going to talk about the individual components of that, and I'm going to focus on the business components of it. What's interesting, if you work in the tax area on a daily basis, is just the volume of legislation that we've seen both this year, starting with the extenders bill, which also had a number of legislative changes that were retroactive, moving all the way through to the CARES Act, which as well has a number of statutorial changes that will allow taxpayers to not only look at the 2019 tax return or tax year, but it will also allow them to look backwards in time, starting with 2018. And as we'll see here, we're going to be looking back perhaps even further than that. So one of the lowest hanging fruits that was out there that they included in the act was an expansion of relief that came about as part of the Tax Cuts and Jobs Act back in 2017. That tax reform legislation allowed a corporation to apply for and receive a refund of 50% of their minimum tax credit to the extent they had a minimum tax credit carry forward into 2018 later years. The CARES Act has now expanded that from 50% to 100%, which has created an opportunity for corporations to go back starting with 2018 and determine whether or not they want to have all of the AMT credit if they did have unused AMT credit in 2018 refunded. If they choose to not do it in 2018, they can elect to do it in 2019. So what we're seeing here is that we have taxpayers across the country that have filed their 2018 tax returns because they were required to be filed based on the due date requirements. But we also have taxpayers that have and have not filed their 2019 tax returns. And so we're going to see a lot of energy put into the question of, should I be thinking about amending my corporate tax return? This topic has gotten a lot of attention, and it's with respect to net operating losses. Again, what the CARES Act did is it changed the rule that was changed as part of tax reform. Tax reform, pre-tax reform, you could carry NOLs backwards 2 years and forward up to 20. Under the Tax Reform Act, the Tax Cuts and Jobs Act, we lost the ability to carry back NOLs, and we were limited in terms of our ability to use NOLs on a carry forward basis to 80% of taxable income. And so what the CARES Act did is it essentially said, hey, starting with 2018 through 2020, we're going to allow you to carry a net operating loss back 5 years. And to the extent that you do that and you can generate refunds or create other tax attributes that would result in refunds, then you have the ability to do that today. Now, the other thing that it does for us is that it takes losses that are generated in 18, 19, or 20, and to the extent we do not carry those back and we have them available to use in 2019 through 2020, we're not subject to this 80% limitation. In other words, the 80% limitation only allowed a net operating loss carry forward to be used up to 80% of taxable income. That limitation has been suspended through 2020, so we can use completely any NOLs at 100% that carry forward. The last thing it did is the CARES Act created a sort of a technical correction that allows net operating losses from years starting in 2017 and ending in 2018 to be able to be carried back 2 years under the old rule. So now I want to talk a little bit about what we are discussing with clients and try and keep this fairly high level. Imagine if you have filed your 2018 tax return, and in looking at that 2018 tax return, you're going to want to determine if you had a net operating loss that you thought you could only carry forward into 2019. If you have that attribute, you can now carry it back. When you carry it back, you have to go to the 5th oldest year. So you don't get to pick and choose. You don't get to go back to the 3rd oldest year. You have to take it back to the 5th oldest year. And then you have to consume the net operating loss starting with the 5th year, moving through year 4, 3, and 2, and so on. Now, the interesting thing about that is when you carry back a net operating loss into those earlier years, we're subject to the tax rules that were in play in that period of time. And one of the tax rules that was in play at that point in time was what we refer to as the 90% limitation. In essence, the 90% limit said you could only use a net operating loss to offset 90% of your taxable income. That effectively created an alternative minimum tax cost. And that alternative minimum tax cost then creates a credit. And so you can begin to see that the thought process behind, do I carry back an NOL and what's the effect of it when I do that, and how will that impact the potential for any other attribute that might be adjusted as a result of that, and what will I need to think about when that happens as it relates to pushing those attributes into younger years. Those are if you will, the computations and the thought process that we're taking our clients through and that taxpayers really are going to need to weigh. One of the real benefits of this is that tax rates for corporations capped out at 35% in years prior to 2018. Currently, the maximum corporate tax rate's at 21%. So there's a 14% benefit that can be yielded if you can carry a loss back to a 35% tax year. So then now what we're talking to clients about is that there's actually a permanent tax savings opportunity here that you're going to really want to think about. And the way to think about that is to say, gosh, if I had an item, say a net operating loss, and I could carry it back or elect not to carry it back, and I'm going to use it either way. I'm confident I know I'm going to consume the net operating loss. Well, all things being equal, if I can carry it back into a tax year with a 35% tax rate, I'm going to get the benefit of a permanent tax savings of 14% times whatever that net operating loss is. So there's a lot of thought that has to go into analyzing this. And as I said, this is going to allow us to go back to 2013. So think about that. We're going to be going back into some pretty old years. In some cases, those years may be closed from a statute of limitation point of view. And taxpayers are going to want to put a lot of thought into their decision-making process around, is the cost benefit significant enough to warrant, filing the refund claims that are going to be necessary. Now, there was also some relief that was provided as part of the CARES Act that allows for some quick refund claims that taxpayers can file. There's a Form 1139 that can be prepared and filed for some of these net operating loss carryback adjustments that allows for an accelerated refund claim. You're going to want to be careful and make sure that you're working with the tax advisor who understands those 1139 rules, because the service is likely going to ask questions about that filing, and you may end up causing a situation where it takes a lot longer to get the refund than you might have otherwise had if you just filed a regular refund claim through an amended return. All right, the next item I want to touch on is the 163J interest limitation that was created as part of the Tax Cuts and Jobs Act. This limitation is one that limits your interest deduction to 30% of adjusted taxable income. What the CARES Act did is it increased that limitation to 50%, beginning with 2019 and applying in 2020. So that's going to be helpful where a taxpayer was otherwise going to be limited by the 30% limitation. They're going to be able to generate a larger interest deduction. Partnerships have sort of a special way that they take advantage of this. The 30% limit still applies to 2019. However, in order for them to be able to get the benefit of the increased limit, what they've essentially said is that you're going to be able to take 50% of the new limit in 2020 and 50% of the remaining, 50% of the 2019 excess interest is going to be treated as business interest in 2020. So that's going to allow you to take a deduction that's not subject to the 163J limitation in the 2020 return at the partner level. Now, remember what I said about the net operating losses? Well, the degree to which 2019 and this affects your 2019 income is going to come into play. So you're going to want to make sure that you're thinking about how this specific tax statute change is going to affect any ability to carry back losses. This particular item, the qualified improvement property, quote, fix, was long awaited. A part of tax reform was included bonus depreciation, 100% expensing for bonus depreciation, but one of the technical misses in the legislation was that assets that were defined as qualified improvement property that prior to tax reform were eligible for bonus under tax reform and were no longer allowed to be claimed for bonus purposes. The CARES Act fixed that, that technical glitch, if you will, in the way the law was written, and that in doing so, it now allows qualified improvement property to be eligible for bonus, and that eligibility is retroactive back to 2018. So for folks that are in the real estate industry space, this is going to be a very highly attractive, but a little bit complicated decision-making process. If you have a real estate trade or business, you were able to make a special election under the 163J rules we just talked about. That special election allowed you to not have that 30% haircut apply. That 30% limitation would not apply if you made the election as a real property trade or business. And if you did that, you were required to use the alternative depreciation system, the ADS class life, for all real property. In this particular case, if you did that, you would not be eligible to claim bonus depreciation for your QIP. Treasury came out and said, hey, we want to incentivize people to be able to take advantage of the bonus depreciation. We're going to allow you to retroactively revoke the election that you might have made in 2018. And as well, they came out with a simplified mechanism for partnerships to file amended returns to be able to make the changes, revoke the election, and claim bonus depreciation on qualified improvement property. This all ties back to that net operating loss carryback rule. And the reason it applies there is as you are looking at your 2018 tax return, you're going to want to think about any K1s, partnership or S-Corp K1s that might have otherwise passed through to that taxpayer. And you're going to want to ask the question as to whether or not there was any qualified improvement property placed in service in 2018 or in 2019 for which you might want to be thinking about making an accounting method change or filing amended returns to take advantage of the bonus depreciation deduction. So we see a lot of work happening looking downstream at those real estate partnerships where buildings and other improvements were placed in service in 2018 and 2019.
So Ben, before you go on, there's a question that Brian posted, and he said, for a company that received a PPP loan, are there any limitations on any of the other tax benefits being discussed?
Well, we're going to talk about some of those in the payroll area, but as it relates to the income tax area, no. Before I go to the payroll area, I just want to pause for a second. I should have had a slide that touched on this. In my 30-year career, I've never seen Congress move as fast with tax legislation as we've seen in the last 4 to 6 months. And the point I want to make is while Congress has moved really fast and provided these paths for refund opportunities, the states have not kept pace. And each of the states has the ability to determine whether or not the state is going to conform or otherwise follow the federal rule. And what we know today is there are some states that, as a matter of course, conform to the federal rule, but to my knowledge, we haven't heard of very many states that have formally come out either through their legislative process or otherwise indicating whether or not they're going to conform. So the decision-making process around capturing these opportunities at the federal level is not the only decision analysis that you're going to want to take. You're going to want to think about the state implications. All right, I'm going to try and move quickly through a couple of the payroll credits. There are some payroll credits that are out there that businesses, employers are going to want to think about. The first one is this employee retention credit. It's a credit of 50% of the first $10,000 of comp. Effectively, it creates a $5,000 credit for your employees. There's two different categories, the way to look at this. The first category, I think I have a slide for the size. Yeah, I need to double check this. You have more than 100 employees and less than 100 employees. And for those of you with more than 100 employees, you have to have retained those employees in order to be able to qualify for the credit. And for this credit to apply, you cannot have received a payroll protection loan, a PPP loan. And so this is going to apply to some of those organizations that statutorily were not able to apply for the loan, for the PPP loan. One of the things that I wanted to point out, not that you have to remember this specifically, but there is some limited opportunity to be able to combine a couple of the credits that are available under the payroll category. So you can combine the employee retention credit with the family leave credit or the sick leave credit, but only for this gap in time. And that gap existed because during that period of time, the payroll was not covered by the sick leave credit, and therefore it created, if you will, a gap where you can look to maximize the credit refunding opportunity. And the last item is, again, this one is not applicable if you receive PPP loan forgiveness. Okay, so if you're successful in achieving loan forgiveness, then you're going to lose the opportunity to defer the when you pay the employer Social Security tax. But if you're otherwise eligible, you have an opportunity to defer the employer's portion of Social Security tax attributable to wages paid from March 27th through the end of 2020. The deferral is 50% of that employer tax is paid at the end of 2021, and the other 50% is paid at the end of 2022. And again, this rule, there are some rules that apply to partners and sole proprietorship. So with that, I'm going to move on and let Kathy, you jump in here.
Okay, so we've talked about the business provisions of the CARES Act, and so now we're going to talk more about some of the items that affect individuals. So first thing, which I'm sure you guys have heard a lot about at this point, is the rebate tax and electronic deposits that are happening. And this is a new credit for 2020, and it's $1,200 per person who is qualified for this credit, and then $500 for each child as well. And there are income limitations on this credit, and so it's $150,000 for married filing joint, $112,500 for head of household, and $75,000 for all others. And so if the IRS had the electronic banking information on file from previous returns filed, then those deposits were made electronically. And if not, then they're sending out paper checks. And there's been a lot of concern about, how are they, which year are they looking at? And so if someone had filed for 2019 early, they probably used that. If not, probably 18. Then there was concern about, well, what if somebody doesn't have to file a return? A lot of retired people are on Social Security and don't have to file a return. And they're going to be using Social Security records from the administration to figure that out. And there's also a place on the IRS website where people can go and put in some basic information about themselves if they have not had to file returns in the past. But I think what a lot of people don't understand about this, this is really an advance payment for a credit that's available on the 2020 tax return. So if for some reason someone is eligible to get this credit, but for whatever reasons they didn't get the check or deposit ahead of time, they'll be able to account for that on their 2020 tax return. So bottom line is, if someone is qualified to get that, they will get it, whether it's right now or it's when they file their 2020 return. And then if someone should get a rebate that turns out to not be qualified, there isn't a provision for repaying that. So, so next slide, please. This one's kind of short and sweet. Student loan. If you have a federal student loan, then those payments are deferred through September 30th without penalty. Again, trying to help people with their cash needs in this interim period. All right, next one. Retirement funds. This is an interesting one because you have the ability, if needed, to take out up to $100,000 from retirement funds that you have either 3 years to repay. So really it's a penalty-free distribution. You know, normally it would be a 10% penalty plus the income taxes on it if you were underage and pulling out money from retirement fund. But what this provision does is it allows people to spread that income tax over 3 years. And if they end up repaying it, then there's really no tax implication from that. And then also for plan loans, that limit has increased to $100,000, and then there's you know, a year delay for repayment of those. So again, trying to give people alternatives to not have to be paying a lot of taxes right now on this money that they may desperately need. Required minimum distributions are something that are required for older people that have their IRAs. It used to be 70.5, then it changed to 72, but regardless, for 2020, a special rule is in place that the requirement for taking that required minimum distribution is waived. And then there's also a 5-year rule that has to do with inherited IRAs, and that allowed people to treat those required minimum distributions as optional for 5 years, and then take the amount out, you know, in that 5th year. And so what this little bit's saying is just, if someone has chosen to do that, 2020 doesn't really count, you know, as one of those 5 years. Okay, next one, please. Okay, this is a big one. Excess business loss limitations. This was new in 2018 as part of tax reform. And as you know, Ben said, you know, we've both been doing taxes for 30 years and not that many changes, you know, big changes. And then between tax reform and then all of this CARES Act and stuff, things just keep changing rapidly. But excess business loss was enacted in 2018. And what it did was it limited for married filing joint people. They were only allowed to take $500,000 of business losses, you know, over and above whatever they were able to offset it against. And then for single people, $250,000. And so what this did is, if you had, it was almost like another layer of limitations. You know, when you have a flow-through business, you first have to look at basis to whether you can take a loss. And then you have to look at whether the, you know, if you have basis, are you active or passive in that activity? And that's further limitations. And then they added in this excess business loss limitation, so that if someone had, you know, really big losses coming through from their business, they were able to offset in 2018 that loss against their wage income, and then some other items of income. But then whatever was in excess was considered an excess business loss that was going to carry over. And interesting thing is, now they've suspended this limitation for, you know, 2 years. So before 2021, it's no longer applicable. But the people that had an excess business loss for 18, or if for some reason they filed early in 19 and showed an excess business loss, they're going to have to go back and amend that return. It's not a discretionary thing. It's a required item to go back and amend the return and then see what the effect is on 18 or 19 if it was really early filed, and then see from there, you know, what you have as far as the loss. And then you have to go through all these other rules to see what to do with it. So the interesting thing is the trade-off then is in 2021 is where we used to be able to offset the business loss against wages. That will no longer be applicable for 21. And you know, the fact that it's not discretionary, it's maybe throwing a wrench in some people's plans where they had this excess business loss that was carrying forward, and they had planned on having that in 19. They had a lot of income in 18 that was more at a capital gain rate. And so by doing this amended return, they may have to be offsetting their business loss against lower rate income than they had expected. So it's not a real simple situation, and just one more complication added. So, all right, next one, please. All right, and then unemployment benefits. There's an additional $600 a week from the federal government on top of whatever is allowed for state, and this is expected to go through July 31st. And then in addition to that, there's 13 weeks of additional unemployment insurance available, you know, at the state level. And, you know, I've seen some stories online and stuff about people being upset with their employer that they were able to get the PPP forgiveness because they were actually getting more money on unemployment than they were when they were employed. I don't know if everybody else has seen those stories, but continually changing. Yeah, Rick's nodding his head, so yeah. Okay, next one, please. So Ben, did you want to kind of recap then for everybody about some of the strategies available then for, you know, taxes and trying to have some cash savings?
I'll do my best.
Okay.
So as we were thinking about our clients and as we've helped our clients sort of navigate through this COVID-19 world that we've been all thrust into, we've had team members like Rick and a lot of others that have really dove into the financial refund loan areas because that's immediate cash, and there was an urgency to that. And we know that there was going to be a run on the bank, so to speak, in terms of how quickly those funds would dry up in terms of Congress creating the available funding. So we've since shifted our focus on some of the other things that take a little bit more time to get the benefit of or the benefit from. And so we just thought we would just reinforce some of these that we talked about. So the ability to defer when you pay the Social Security tax that we talked about, that really is an interest-free loan. It's a way to hang on to your cash that you otherwise would have had to send to the government with your 941 deposits, and defer when you send that cash to 2021 and 2022. And it's something you should really think about. And to the extent that you take advantage of it, you're going to want to plan for how you're going to repay it and when you're going to repay it. So that's a first one I wanted to touch on. The net operating loss, I flew through that. And there is so much to think about in terms of the ability to go get refunds. And that is a big part of what Congress intended when they set aside the dollars and valued or scored the dollars that the CARES Act was going to cost to be able to provide funding. But we know that there's some things you can do in the very short run. You can, if you have the right attributes, you can file an 1139. You can get that filed on or before, I think it's July 27th, and you can accelerate getting some of those refunds. A simple way to do that, as an example, is you overpaid your estimates for 2019. you know what your taxable income is and you know you overpaid, there's a way, you know, these are things that you're going to want to think about. Little less obvious or intuitive is this rate difference, but the rate difference can be substantial depending on the size of your taxable income. And it's definitely it's a permanent savings. For those of you that have audited financial statements, you're going to have to think about how all of this impacts your tax provision and financial reporting. We're spending time talking to clients about accounting method changes, and an accounting method change could be attributable to that qualified improvement property where we're electing bonus depreciation instead of the ADS class life and depreciating over that time period. But there are other accounting methods that come into play that taxpayers should be considering, because accounting methods allow us to control the timing of income or the timing of a deduction. And to the extent that we have an open tax year or a year in which we can make an accounting method change either through an amended return or filing a 3115, then that represents a tool in our toolbox that we can use to influence what happens to taxable income in that year. And as we've talked about, we have a bunch of positive openings in 2018, 19, and 20 that may allow us to bundle income or deductions and cause shifting in income that would otherwise be the same over the, in other words, an accounting method changes the timing of the recognition of an item of income or deduction. It doesn't change the total. It's a shift between time periods. But playing with and manipulating the shifting in recognition can create significant opportunities. Again, I would call out that rate difference. To the extent you can carry a loss back and you can increase that loss because of an accounting method change that you make today and carry back that loss to earlier years where tax rates were at 35%, you're going to create more income and more cash than you would if you didn't do anything and you just use the benefit of those deductions in the future. And then Kathy's comment about the excess business loss, that this is one of those sleeper law changes that most taxpayers are not going to remember or understand how it impacts them. But you're going to want to, you know, if you receive K-1s or you operate a sole proprietorship and in your individual return, you're taking advantage of those business deductions, you're going to want to make a note to go back and look at 2018 and 2019 and talk to your tax advisor about how and if this applies to you. Because as Kathy pointed out, this isn't an optional change. And the reason it's not optional is because of the statute being retroactive to 2018, it impacts the attributes that are coming forward into 2019. And so what you don't want to have happen is you don't want to be surprised by, you know, your conversation with your tax preparer when you're looking at your 2020 return because you've already filed 18 and 19, and they say, guess what? The attributes we see or thought were coming forward into 2020 are not the attributes. You actually don't have those losses that you thought you were planning on in 2020. And instead, we got to go amend a return, pay the tax. You don't want to be surprised by those things, and they're not intuitive. And so we're just really encouraging our clients and folks to take a look at their individual returns for that implication. Minimum tax credit carryovers, these are low-hanging fruit. If you would find this very quickly in your return, you know about it to the extent you can amend for it, and it's your only item that you're amending for in 2018. It's a simple fix. It's relatively inexpensive to amend that return, hopefully, and you can generate a refund pretty quickly. And that leads us to questions, and just about out of time as well.
Yeah, and I don't see anything in the Q&A or chat at the moment, so we'll give people just a minute to see if there's anything that's on their mind.
Kathy, I was going to ask you, you know, the waiver of the required minimum distribution provision. Well, what would you advise someone who has already taken some of their distribution in 2019?
I think that if they've already taken it, there's nothing to be done for 2020. So, you know, if they have not yet taken it, though, that's their chance to say that they're not going to do it. All right, we've just seen something pop up here. Let's see. Okay.
Well, I wonder if that one is for me. I missed the response on this, and I think the original question came from the same individual. And the question was, for forgiveness purposes, what's the amount or threshold for highly compensated individuals? So you can take and include within the forgiveness calculation compensation up to the prorated 8-week equivalent of 100,000 annually. So that works out to be 15,385 would be the max amount of cash compensation that you can include for forgiveness. But on top of that, you can include non-cash compensation. That's just the threshold for cash compensation.
So Ben, do you want to page down one more just so they have our contact information in case anybody wants to have it? And then we'll be providing these slides to Robin, and she'll be sending it out to the group as well, so you'll have it for your reference. And I think that takes us to the end of the period. We appreciate everyone spending your lunch hour with us and hope this was helpful. And thank you, Ben and Rick.
Yep. Thanks for the opportunity. Everyone. Bye, everybody.
All right, bye-bye.